Hello, welcome to AQ Accounting. In this video, I'll be going through the basics of double entry. So I will try and keep this as simple as I possibly can to make it the easiest video on double entry bookkeeping. So you're probably watching this video if you're quite new to the subject, and I'll simply explain how double entry bookkeeping works. So just think of it as like this, okay? Imagine you are starting off your own business, and the need is that you have to open up your own. You have to open up a new business account. Okay, so you have your own personal account at the moment, your current account or a savings account, but for the purpose of this business, you have to open up a business account. Now, what does that mean? It means going to a bank. It means opening up a business account for you to use for any business transactions. Anytime you sell something or you purchase something, that money goes into that business account. Okay, so what we're going to do is we're going to have what we call a T account, and it's called a T account because it looks like the letter T, and we're going to call it bank, and this is our bank account, okay, our business account. Now, the first ever transaction for your business account will be, obviously, you can't spend money if you don't have money. So the first transaction will be is when you go to NatWest or Barclays and you say, "Can I open a business account?" and you put some money into the account. That's the first ever transaction. Okay, in accounting, we call that capital introduced. When you introduce capital, when you introduce investment. Okay, and like I said, before you can even spend money, you've got to have money in that account. So the first transaction is when you put £1,000 into that bank account. Now, this is called double entry bookkeeping, and the reason why it's called double entry, and that means every transaction will have two entries. Double meaning two. Now, what does that basically mean? It means if you put a transaction here, then you've got to put another transaction somewhere else. Okay, so what we're going to do is we're going to have another T account, and you've got to use two T's. Every transaction there's got to be two T's for. So we're going to have one called bank, and we're going to have another one called capital. Okay, now just when you have the bank account, you have two sides to a T account. Now, this is called the debit side, and this is called the credit side. Think of this as money going in and money going out. And you can only use the logic of in and out for the bank account. You can't use it for the other accounts. It's not always going to make sense. But all I want you to do is think about, there's got to be, for every transaction, there has to be a debit and there's got to be a credit entry somewhere else. So for example, like I said, we're going to keep this simple. We've put money into our bank account. What have we done to the bank? We have debited the bank. Okay. Now that means we have to put something into the other account, the capital account, and this shows the amount of money we have invested. So what are we going to do with capital? We are going to credit the capital account. So the principle of double entry is that you have a debit transaction somewhere and that you have a credit transaction somewhere. Because for this capital account, this is the debit side, this is the credit side. Okay, so look at this. We have a credit entry and we have a debit entry, and that is how the system is designed. Okay, so all you need to understand here is for every transaction, there are two accounts. Number one. Number two, every T account has a debit side and a credit side. Okay, so every transaction will have a debit entry and a credit entry, and that a T account will have a debit side and a credit side. Okay, and that when you put a transaction in, you have to use two accounts. You can't say, I'm going to debit the bank and credit the bank. That doesn't make sense. Okay, you're either putting money in or you're taking money out. Okay, so that's the first ever transaction for any company will be to put money into the bank account. Now, what happens afterwards? So realistically, you could say that, okay, once I've put my money into the bank account, I'm going to then spend some of it. Why? Because you might need to buy machinery. What do? What would be the transaction? So you have a T account, and it needs to be called something appropriate, and you could call this machinery, and that would be fine. Okay, I'm not really used to writing with these, but I think you get the point. Okay, so we have a machinery, a T account, and you can have pretty much a T account or an account for everything really. Okay, obviously there are some things like stationery. I mean, you're not going to have a T account for pens and one for pencils and one for rulers and one for staples. Okay, you probably just have an account for stationery, and you just, anything to do with stationery, you just chuck it in there. Okay, but we have one for machinery. So let's just say now the second transaction for this business is, I don't know, we're going to buy some machinery. So what do you think? Do you think you're going to have money coming in or money going out? Now, I would say you're going to have money going out because you're spending. So let's just say we're going to spend £500 on machinery. So we're going to have £500 coming out, and we're going to have £500 coming in. Okay. Now, like I said, the bank account used the logic of money coming in, money going out. However, for the machinery account, you can't really argue that money's coming into machinery. You can argue that, but I would just think of it as, and like I said, keep it simple. Think about the bank. Is money going in or out? If you answer the question, money goes out, that is a credit entry there. It must be a debit entry over here. Okay, so money is leaving the bank, but it's going into the machinery account. Now, what is the point of what we're doing? Okay, the point is that at any given time, you can go to an account, for example, capital, and you can check how much you've invested. You could go to the machinery account and you could see how much money you've put into machinery. So it's a bit like a notepad, really. It allows you to go into a T account and you can actually see in there what money, where your money has gone, where the money has gone, where it's been allocated to. It's a bit like when you go shopping, you might have £100. You might spend £10 of that on, junk food, crisps and chocolates. You might spend £10 on dairy products. You might spend £20 on cleaning products, okay? But you know that you had £100 to start off with. Where has it gone? You spent some in machinery. You might have even spent some on wages. Okay, so we're going to have a wages T account. And we're going to spend £100 on wages, and money is going to go out the bank and it's going to come into the wages account. So these T accounts allow you to see the initial capital you put in, where has it been allocated to? Okay, now that's a simple way of showing double entry. And like I said, the difficulty with this is students start to think about their own bank account. It's not, it's a business account. Capital reflects the investment that you put in. That won't change. That will stay at £1,000. If I was to ask you the question now, the £1,000 that you put in, where is it gone? Your answer will be, I spent 500 on machinery and I spent 100 wages. Now that's £600. Where's the rest of it? It's in the bank, because I had 1,000 coming in and I had 600 going out. So I've got £400 left in the bank. 100 on wages, 500 on machinery. Okay. Now, if you were to go to your actual bank account and you said, and you asked them, can I have a mini statement? Or you go onto your phone and you go onto the online app and it shows £400. If you wanted to know what was the initial investment, you can go to Capital. Capital will show you what you invested. That won't change really. Okay, it won't change. The purpose of this is to show how much you started off with. It will not change. Okay, these two accounts Let me just get the light back on. Okay, the other two accounts, meaning these two, that will show where your money has gone. Okay, now this video simply just explains the debits and the credits and how each transaction should have a debit and a credit somewhere else. Okay, and they have to be opposite sides, a debit for a credit. Each transaction also has to use two accounts. You're either using those two or those two or those two there. Okay, what this video doesn't show is what you need to build on in terms of your knowledge, in terms of the detail. Okay, so each, normally with a T account you would have, and if I just get rid of some of this, and I'll just show you one example. Let me just show you another new tab, it'll be easier. Okay, so when you have a T account, I told you guys, you don't need to write debit and credit on each side. You don't need to do that. But with the example before, when we put £1,000 in, you actually have 3 columns on a T account. Okay, so this is going sort of a step further. Remember we showed £1,000 coming into the bank account because we put £1,000 of our own savings and we went to a bank and we put money in. Then you have a detail, so you have the amount. Then you have a detail. Okay, and then you have a date. So there's actually 3 columns to a T account. The detail is the account. Now, the £1,000 that we put in, that was for capital. You can see I'm not very good with this. And the date could be the 6th of June, which is today's 6/6/23. Okay, so that could be the date. My handwriting is really poor on here, apologies. But we've got the date, the detail, and the amount. So if you were to go to the bank account, you've put £1,000 in for capital investment, and that's the date. And then again, if we have a look at the second transaction that we did, we spent 500 on machinery. So again, we can have a date, detail, and an amount. And we've spent £500 on machinery, so we spent 500. It was for machinery. I'm going to have to abbreviate there because I can't get it all in, or maybe I can. Just about. Okay, that was machinery. And we could say that was done on the 7th of June 23. Okay, so that's taking it a step further, that a T account will have 3 columns. One for the date of the transaction, the detail, meaning the other account that you've used, and the amount. Okay, and if we were to do the second transaction, that was when we paid wages. You could potentially have a go if you want. You could pause the video. But we spent 100 on wages, and we could say 7/6/23 as an example. Okay, so that's step 2 of T accounts. Step 3, which I'll finish off now, is balancing the T account. Okay, and that's where you draw 2 lines as a total, and that's where you add up. Now if you look at these two, which one looks larger? That looks larger there. So you put the £1,000 in and you write the same figure in the other total box. They've got to match. Look at the one which is larger, write it in the total, make sure they match. Now obviously that adds up to 1,000, this does not. So you have to make it balance, and the difference is 400. Okay, and that we would call, the detail is, we call that balance carried down. That's the balance at the end of the month. That's the balance at the end of the month. Okay, so the steps for balancing are, look at the side which is larger, put the total in the total box, take it across to the other side. It could be the other way around. You just follow the steps of looking at the one which is larger, take it across either way, and ask yourself, does it balance? Well, this side balances, this side does not. You make it balance. Whatever the figure is to fill in the gap, That's what you need to put in. So we put £400 in there, and that's balance carried down. That's the balance at the end of the month. Logically, 1,000 came in, 500 went out, 100 went out. We have £400 left. And that becomes the balance, obviously, after 30th of June. What's the next day? 1st of July. 01, 07. This is called balance BD. Okay, balance brought down, carried down. Now, carried down is at the end. Brought down is at the start. And if I ask you, if today is Friday, for example, and you have £400 Friday, what do you have on Saturday? You have £400. The balance at the end of one day becomes the starting balance of the next day. If you go and check your account and you have 10 grand Friday night, 11:59, midnight, just about midnight, well, 12:01 Saturday AM, you're going to have the same amount. So the balance at the end of one day becomes the opening balance for the next day. Okay, so that's step 3 on how to balance your T account, and I'll put some more videos on the basics out there soon. Okay, I'll leave it there. Thank you for watching.